In this video, I want to talk about deferring your mortgage payments. This is something that is a rather serious thing to do, and it should not be entered into without some good information. And that's the purpose of this video. Usually my audience is students of engineering economics or students of finance, but in this instance, I would like this video to be for anyone who has a mortgage. And if you are a student and you don't have a mortgage, most students don't, but you know someone, a friend or family member who has a mortgage, I would encourage you to send them a link and let them watch this. It's kind of an unusual time, and many people are not able to make their regular monthly financial obligations. And banks have made this, let's say, seemingly generous offer where they will allow people to skip, in some cases, up to 6 months of mortgage payments. And for some people, that may be necessary. However, the banks still charge interest, and that is something that should not be underestimated. I'm not going to get into any of the actual financial calculations in this video, although it is something I would encourage students to attempt to replicate. What I'm going to do is basically just use an example to show people who have mortgages the effect of the extra interest that you will be charged if you elect to defer your mortgage payments for 6 months. And to do this, I chose a somewhat typical mortgage amount. I chose a $300,000 mortgage, amortized over 25 years. That's the fancy word for that's how long it's going to take you to pay off your house. And I chose a kind of typical value that many people with a fixed rate mortgage may currently have. I chose 5%. If you crunch the numbers, you end up with a monthly mortgage payment of $1,745 per month for this $300,000 mortgage. Now, if you don't already know this, you will end up paying quite a lot of interest over the 25 years of a mortgage like this. In fact, for this particular case, you will end up basically paying $220,000 in interest. And that is if you just take the amount of interest that the bank is charging for each month over those 25 years, add up all those numbers, it adds up to $220,000. So if that comes as a surprise to you, then whoever sold you your mortgage probably didn't properly explain things to you. What I want to get into now is the extra interest that you end up paying if you skip 6 months of payments. So it's a difficult topic. You can't just say one number because in actual fact, it really depends. It depends on how far along you are in that 25 years. So people who are closer to the end will be much less affected than people who are near the beginning of a 25-year mortgage. So I'm going to start with someone who is, let's say, 15 years into a 25-year mortgage, meaning that they have 10 years left. And for someone in that situation, so if someone's 15 years in, they'll end up paying about $7,000 in additional interest by skipping those 6 mortgage payments. Okay, so maybe it doesn't sound that bad, and maybe if you don't have a choice but to skip the payments, then maybe it's something you can live with. It is also notable that after the 6 months, if your monthly payments remain the same, and that will sort of be a good question to ask your bank if the payments are going to stay the same at the end of the 6 months, or whether the bank will ask you to increase your payments. You should check on that. But basically, if you keep the payments the same, you're going to add time to that mortgage. So even though you only skipped 6 months of payments, you're going to add 10 months to the amount of time it takes you to pay off that mortgage. So that's something that sometimes people don't really appreciate. Now, The situation gets worse for someone who is newer to that 25-year mortgage. So if I look at someone who's, let's just say, 5 years in, meaning they have 20 years left on the mortgage, they're going to pay about $18,000 in additional interest over that next 20 years as a consequence of skipping those 6 months of payments. Not only that, they're going to add, a year and 5 months to the amount of time it takes for them to pay off the mortgage. Again, that assumes that after the 6 months, they resume those $1,745 monthly payments. It may be that the bank will require you to increase your monthly payments to get back on track to finish that mortgage off in closer to the original 25 years. Now, I saved the worst for last, and that would be for someone who has what I would call, let's say, a brand new mortgage. If they just got a $300,000 mortgage and the first thing that they do is defer payments for 6 months, they're going to end up paying, kind of a whopping $27,000 in interest over that next 25 years. So, like I said at the beginning, I wanted to make sure that people had a better understanding of the consequences of skipping these payments. And if you have the means to still continue making your monthly mortgage payments, I would encourage you to do so. And that really, this number, especially for someone who has a new mortgage, is something you need to be very, very careful of. So anyway, this was just a short video to talk about deferring mortgage payments. I hope it was helpful to you and helped explain some of the consequences that maybe in the media or maybe even on your bank's website is not properly explained.